Welcome to the Real Estate and Tax Talk podcast with your hosts, Ricky and Steve. Brought to you by Affiliated 1031.
Hi, my name is Ricky Guerrero, and I'd like to welcome you to our podcast, Real Estate and Tax Talk. I'm sure you're probably wondering how you got here and what the heck you're doing here. So we are real estate and tax attorneys who really want to educate our viewers and listeners a little bit more about why real estate and taxes are very beneficial and why they intertwine so well that they can help, everyone be successful financially. And that's why real estate has been linked to being one of the best assets to invest in over everyone's life, right? So, like I said, my name is Ricky Guerrero. I am an attorney here in South Florida. I've been practicing real estate law for 5 years. I feel like I'm doing a Tinder bio trying to get a girl, but I have been practicing for 5 years. The only reason that I know anything that we're going to go through is because of my experience and my education in the field of real estate. I'll let Steven toot his own horn, but he has a master's in tax law, so he's a much bigger nerd than I am, but I'll let him do that.
So my name is Steven Gurry, and I'm an attorney. I've been practicing law for a little over 10 years now. I got my LLM, which is a Master of Laws in Taxation at UM. So yeah, big time tax nerd. Literally spent another $50,000 just to study tax law. So incur more and more debt. So like Ricky was saying, we do this to try to put money in your pocket, try to save on taxes, and because we genuinely enjoy it. And we want to educate you guys out there who's, if you guys are looking to sell investment in real estate and you want to buy something, this is the trick. This is how you save on taxes. This is how you eliminate, paying, or I should say deferring paying taxes and different levels of taxes when you're trying to expand your real estate portfolio.
Right. So, the main topic of episode 1 today is 1031. So what is a 1031 exchange? What is the tax code, a 1031 exchange, and why is it so beneficial for someone who owns real estate? In simple terms, it's if you own this water bottle and you bought it for $1 and then you're going to sell it for $5, you have a $4 profit. What people don't think about is, they think I got a $4 profit. It's great. I can't wait to put it in my pocket. Until you have to file tax returns and you have to claim that you sold this, and then you're going to pay taxes on those $4 that you earned. So you pay after the fact. You don't pay when you sell it, and then your $4 profit goes down to about $2 profit. So that's kind of simple taxes there, but there is a way, and this is what 1031s are for, where you're able to not pay those taxes at the time of the sale, defer them, and buy a nice bigger water bottle, right? And then you don't have to pay taxes. You defer them at the time of that sale. And that's a very simple way of putting what a 1031 exchange is. Imagine when we're talking about real estate, we're talking about tens of thousands, hundreds of thousands of dollars, millions of dollars in taxes. So what is a 1031 exchange?
So just like you said, a 1031 exchange is a tool, it's a mechanism for any kind of real estate investor to sell this house, buy this house, and any gains, like you were saying, that are attributable to the sale of this house, any taxes on those gains are completely deferred. And you keep doing this over and over and over again, and potentially not pay capital gains taxes. And it's not just that too. So there's other types of taxes that...
Let's slow it down. For those that don't even know anything about real estate who might be listening, gain is in essence like profit, right? They might think of it as a profit. So can you explain a little bit more about what is gain, and then what is a capital gains tax?
Sure. So gain is, like you're saying, it's profit. So let's say I bought that house for $100. That's my basis. That's what I contributed.
Right. Your initial contribution.
Exactly. That's my contribution to, purchase this property. So in your example, let's throw a couple of zeros, on that. So instead of $5, just say, $500. Your gain is that difference between what you paid for at 100 and what you're selling the property for. So 500 in this case. So $400 capital gain. So now the tax on that is, it just depends on your holding period. It depends if it's long-term capital gain, short-term.
What is the difference between short-term and long-term? I know, but what's the difference?
So short-term capital gains is tax is a tax on capital gains when you sell something in capital assets like stocks, real estate. That's what we care about here.
Sorry, this is really boring. It's all about taxes, but you'll get. I promise you're gonna learn something, and I promise it'll be beneficial to you. Just give me. We'll have to go through the dry stuff, but I guarantee you that you're gonna learn a lot, and it's gonna help you.
It'll be more fun.
And if you do know what a 1031 is, I promise you'll learn something that you don't know. But short-term capital gains is basically what Steven was saying. Is if you have an asset such as a real estate property, and let's say you sell that property less than a year and a day, short-term capital gains applies. So if you have any gains, so any profit, you'll be taxed on that up to 37%.
Yep, up to 30. So anywhere from 0 to 37%, depending on your tax bracket. And then long-term capital gains, same thing, but you're selling a capital asset. So what we care about here is real estate. If you've held on to it for a year and a day or longer, so then that is anywhere from 0 to 20%. And then, depending on your tax bracket, if you kick in the Obamacare tax, and that works for short-term capital gains too. You kick in the Obamacare tax of 3.8%. So potentially 23.8% is what you're going to pay in long-term capital gains when you sell real estate.
So in your example where you purchased a house for $100 and then you sold a house for $500 and your gain was $400, you could possibly be paying taxes on up to $80, $90 of that $400 profit.
Yeah,
just on capital gains.
Yeah, just on capital gains. So yeah, if your profit or your capital gains, 400 or 400,000 or 4 million, whatever the case may be, 100 is essentially going to Uncle Sam because almost 25% at that point.
Yeah, exactly. It's almost 25%, so it's almost 100, which is what people don't think about and what really separates, a real seasoned commercial or real estate investor that has a portfolio. They begin to use the tax code to their benefit. They don't evade taxes. Nobody here evades taxes. We love the IRS more than anyone else.
Yeah, in case they're listening, we pay our taxes.
Yeah. But they just use the tax code to their benefit, and one of the benefits of the tax code is 1031. The real estate and the tax code are intertwined. They're so beneficial to each other. It's just learning how to play the game and use the tax code to your benefit.
Yeah, 100%, because you do this, and it's funny. So you sell real estate now, right? And you get that check, like you're saying, like the $400,000. I don't know of anybody that's actually disciplined enough to set 25% of it aside or whatever the case may be. And then, okay, come next April, I'm going to pay my taxes on it. That usually doesn't happen.
Yeah.
So then, if you don't do this, you're going to get hit with a huge tax bill,
when you file your tax.
Yeah, exactly. Come next tax season. So if you utilize this, you don't have to worry about that tax bill. And then you're, growing your portfolio. So it's a really, really great tool.
So that's one of the taxes that apply to real estate and assets in general, is the capital gains tax. But there's also another tax when you sell real estate that people don't know about and don't even think about. And 90% of people have never even heard of it.
Yeah, depreciation recapture tax. So that's a fun one because most people that have investment real estate depreciate property. And you typically depreciate property over 27 and a half years.
For those that don't know, what does depreciation mean? Like, to depreciate a property, what does it mean? And what is the tax for depreciation recapture?
So in reverse order, so it could be up to 25% is depreciation recapture tax.
So when you sell the property, you could be paying not only capital gains tax up to 23.8%, but you could also be paying depreciation.
Yeah, both. So almost half.
What if you don't depreciate the property?
So the IRS will actually impute depreciation. So depreciation is, like anything, things kind of deteriorate over time. So when you're taking depreciation...
Except me, baby. Fine wine.
Yeah, fine. Yeah, wine is the only thing that gets older and gets better, right? And scotch.
Like me. But okay, go back to depreciation.
So property deteriorates over time. So there's a schedule the IRS gives us. It says, okay, so, the value of the property will potentially go down to 0 after 27 and a half years. That's just some arbitrary number they come up with. I'm sure there's some actual logic behind it, but that's just what they say. So you divide the value of the property generally by 27 and a half, and that's what you depreciate. But even if you don't do that and you don't take it on your tax returns, the IRS is going to say, you know what, you should have been taking depreciation. We're going to impute that on you anyways. So even if you weren't actually taking depreciation, the IRS says, too bad, so sad, and you'll be paying.
So if you don't take the benefit of depreciation, you still get taxed on it when you sell.
Exactly. So this is huge. This is huge. And then another thing is state income tax, right? So that's a third tax
Luckily, we're in Florida.
Yeah, so we're in Florida. We don't deal with, state income tax, but there's many states in the country that do. And I think, most states in the country have.
Yeah, most states in the country do. When it comes to 1031, specifically, you're able to defer taxes on 46 of them. There's
Yeah.
4 that have clawback provisions. One of them, as you can imagine, is California.
Yeah, of course.
Loves to claim taxes on absolutely everything.
Yeah, of course.
So we got the 2 taxes. Let's use an example, though. So let's say your same example, but let's use real figures because nobody could buy a house for $100 unless it's a squishy house for stress. So let's say you buy a property for $200,000 and you then sell that property for $700,000 3 years later. So run through me with the taxes on that. How much can they be paying up to on taxes if they do not do a 1031 exchange?
So we're talking about a capital gain of 500,000. Yeah, so that's like a real world number, right? So just to round up, you're talking about capital gains tax of 100,000.
Maximum.
Maximum, yeah. Almost 100,000 plus depreciation recapture tax of 25% of that gain typically. So that's another 100,000. So about half of your gain is going to Uncle Sam. So your purchasing power, if you wanted to buy another piece of investment real estate, your purchasing power is basically half now, unless you do a 1031,
Yeah, I don't know about you, but that does not sit well with me.
No, definitely
I don't want to pay 200. I love the IRS, but I don't want to pay $200,000 to the IRS out of
if you don't
profit that I made when investing in real estate. So what is a 1031? A 1031 is a tax code which gives people the benefit to not pay these taxes at the time of sale and defer them, to roll them over. So what's really required, right? What does it say? It pretty much is, in layman's terms, that if you own a piece of real estate investment property, you can sell that piece of real estate investment property and buy a new real estate investment property within certain timelines, which we'll get into, and you don't have to pay the tax at that time of that sale. You can defer them.
Yep, 100%.
So imagine your same example. Instead of paying the IRS or the government $200,000 in taxes, I'm able to do what is called a 1031 exchange and defer those taxes and roll it over into a new investment and keep investing in real estate properties.
Yeah, and you're doubling your purchasing power, right? So in your example, instead of 200K that you have at your disposal, you got 400. So, maybe you could buy 2 properties instead of 1, and, you could leverage your cash and, start cash flowing a little bit more. These rental property.
It is honestly, every time I tell someone, they're so surprised that this has been around for 102 years. Nobody knows the secret. Ultra rich do, and the real big time investors do. And even them, I've spoken to some, and they wish that they knew this earlier, which is one of the main reasons why we're doing this.
Yeah, it is. It's to educate everyone and let them know this exists so that you can use this tool and create, generational wealth. Not too many people, even the educated people don't know this. Like you were saying, even
Right.
lawyers don't know about it.
Even lawyers or realtors or CPAs don't even know this. I actually had a conversation about 2 months ago with an investor whose net worth is about almost 200 million, and it's mostly real estate portfolio. I asked him about 1031 exchanges and if he uses it. He said that he wished he would have learned what a 1031 exchange was a lot earlier, because he said he would have gotten to where he was probably 5-10 years before.
Yeah, now it would probably be worth, 400.
Exactly.
Right? So, yeah, you got to get into it early.
Yeah, I mean, that's the very difficult part, is nobody knows about it, and that's sad. I mean, I think everybody should know about it because it's so beneficial that the government has been trying to get rid of it for like 20 years.
Yeah, the last 4 presidents have been trying to get rid of it. So this isn't a Democrat or Republican thing. Like, everyone's just trying to go after it. So you got to use it while you can, right? So let's talk a little bit about like how the 1031 works, right? So you want to sell this property. Now what comes up next?
Right. So if you want to sell, if you have a real estate investment property, you have the opportunity to do a 1031 exchange. So what happens? You get under contract, you want to sell, and you have to make that decision. You either want to sell and pay taxes to Uncle Sam, or would you like to reinvest that money and do a 1031 exchange? Hopefully you are a understanding individual and want to do a 1031 exchange because you don't really feel like paying taxes and you want to, get the most out of your money. So from the time of closing of your sale, well, we have to partake in that transaction as qualified intermediaries, right? So what is a qualified intermediary? It's affiliated 1031. It has to be someone who is completely independent. There's documents we prepare, as you know, and everything needs to be signed. We're part of the closings. The funds come to us at closing where we hold them in escrow for your 1031. And then you have your timelines. And what are those timelines?
So we got 45 days and 180 days.
Right. So when do they begin and what exactly are those timelines? And by the way, we're speaking in regards to when you're closing on the sale of your real estate investment property.
So let's say we sell, right? And we decide, you know what, we're going to give these affiliated 1031 guys a shot. Don't want to pay Uncle Sam any money. What happens, right? So we sell a house. That day is what starts all our timelines. That's what puts the 1031 in motion. So you got 45 days from the day that we sell to identify something. And that doesn't necessarily mean go under contract. It just means, hey, Steven, I like this house. Thinking about including in one of my 3 properties when we do a 1031 exchange. I like this house. So you just email me, that's how it basically works. It'll email you, a couple of addresses, and that's how you identify a property. You don't need to be under contract. You just got to tell us that there's this property out there.
They're the prospective properties.
Exactly.
And that's the identification. The other deadline is 180. So from the day of closing of your sale of your real estate investment property, you have 45 days to identify, 180 days to close. These timelines are concurrent. They're not separate. People like to think they're separate. They're concurrent.
Yeah.
So it's really difficult. I mean, obviously the IRS isn't going to make it easy for you not to pay taxes, right? So it's really difficult to identify something. So what I often tell clients is you need to start looking now, like before closing date. Because remember, your timeline doesn't start until you close.
Yeah, nothing keeps you from
you had a
right?
recent example of that, right? The one that got extended?
Yeah, so we had a case where, somebody did a 1031, was trying to do a 1031, and they were under contract when they were selling, and contract fell through. And I told them, look, use this as an opportunity. Just because you don't close doesn't mean you still can't do this.
Right.
Now you have more time to identify, especially here in South Florida, right? Like the market's crazy. So 45 days doesn't necessarily, get you anywhere, So use this as an opportunity. Start looking for properties now, start touring houses and condos and things like that now. That way when you do close and your 45-day timeline actually starts, you've had all this additional time to look for something there. So it's, wasn't that big of a deal, Yeah, they wanted to close, they wanted to rush and get through it. But I said, look, use this as an opportunity, even though you guys didn't close on your...
Yeah, because the timeline doesn't start until you close on the sale.
Yeah.
Right? So I want to go over actually an example I have that kind of will detail what is a standard for 1031 exchange. So I had a client who reached out to us, was selling their investment property. They had probably $800,000 to $1 million in gains, right, in profit. So they want to do 1031 exchange. Closing occurs. They have their 45 days to identify, 180 days to close. They identified a property within the 45 days. They close on it. They've got a contract and close on it. They purchase for more, and they defer their taxes. It's really simple. I mean, if you think about it, it's just very difficult knowing the actual tax code and difficult knowing the guidelines. But that's what we're here for. Right?
Yeah, exactly. Yeah, we do all the hard stuff, right?
All the hard stuff, but all the easy stuff too. I mean, it is important that everyone knows this. So we kind of have to break it down so everyone understands what they're getting into. We don't want, for all the exchanges that we have, we don't want anyone getting into it unless they know what they're doing. Yeah. Or at least have a good understanding of what they're getting into.
Yeah. So we do all the hand holding and all that fun stuff for them. So, they'll be in good hands, obviously, if we're taking care of them.
Yeah. So what is and then I'm gonna let you go over this, the napkin rule.
The napkin rule, right? So essentially, whenever you do a 1031 exchange, you want to use 100% of the money that you get when you sell.
Your what we call in the real estate world, your net sales proceeds.
Exactly, your net sales proceeds. So you have to use 100% of it in order to not pay tax. I mean, doesn't mean that you can't do what's called a partial exchange, right? So let's say you want to keep,
Wait, so hold on, before you get to that. So you have to use whatever funds you're going to get from that sale and purchase the same value or more than what you sold for.
Yeah, to get 100%.
To defer 100% of taxes. A question I get all the time is, okay, what if I don't buy one property, but I buy 2 or 3 properties? Do they add up, or is it just the one property that counts?
No, so obviously if you're doing like the 3 property rule and you're going to spend the money, as long as you spend all of it, whether it's 1 property, 2 properties, or 3, you're good to go.
Yeah, so as long as you identify them, right? That's the very difficult part of a 1031 exchange is because the timeline's so short. Is to actually identify, and it's ideal to have a contract, not necessary how you say it, but it is ideal to have it. However, you don't have to at the end of the day. You could.
Yeah, you don't have to. You don't have to.
But once your 45th day passes, whatever you identify, you're stuck with.
Yeah, it's game over. So whatever you identified, you got to close on it, or you just don't do it.
Yeah, and then all fails, and you just pay the tax.
You actually just reminded me now. So what's the one thing about the 45-day deadline and the 180-day deadline that a lot of people don't know about?
No, it doesn't matter if it's on a weekend or a legal holiday.
Exactly, yeah. So
you get what you get, and you don't get upset. The IRS, they only offer extensions to that when there's a natural disaster. Last year in Florida, we had was a Hurricane Ian?
Yeah, we had 2, I think.
And then they offered some extensions for specific counties that were affected by the hurricane. But other than that, they don't care. It doesn't matter if it's Saturday, Sunday, your mother's birthday, or a legal holiday. Your 45th day deadline is your 45th day deadline. And 180 days, yeah. They're both doesn't matter. It's not, I know real estate, if like you're a realtor or a real estate attorney watching this, contracts are different. Where contracts are, if it ends on a Sunday or legal holiday, it rolls over to the next business day. These are calendar days. This does not matter.
So, yeah, they want to make it hard for us, right? Like if they're going to give you this way out of paying, they're going to make it a little bit more difficult.
Oh, yeah. So that's the napkin rule. You were trying to get into a little bit, and I interrupted you.
I forgive you. It's okay.
I mean, whatever. Just buy me lunch. I interrupted you on a partial exchange.
Yeah, so yeah, the napkin rule is you got to use 100%.
Right, so you have to use, so let's use an example for people. So let's say you're selling a property for $500,000. That means in the napkin rule that whatever you were supposed to receive at that closing, you're supposed to use it towards your 1031, and you have to purchase 1 or multiple properties that will be $500,000 or more in order to completely defer taxes.
Correct, yeah. So if you do a partial exchange, let's say you want to pocket $100,000, right? You can do a partial exchange. You defer on the rest, I guess on 300 in your example, and then you pay tax on the 100.
Right. So that's like if someone wants to, for example, I'm closing on a sale of 500,000, and I'm like, hey, I want to just keep 100,000 in my pocket, maybe go buy a drink, and then I pay taxes on that money, but I can still defer the rest.
Yeah, you could still defer the rest.
So that's the same scenario. Whereas if I sold my house or my investment property for 500,000. And now I don't keep any money. All the proceeds go into the 1031, and I only buy 1 property for investment for 400,000. Now I just defer taxes on the 400,000. I'm gonna pay taxes on the difference.
Correct. Yeah. So
it's the same way.
Yeah, you're essentially pocketing. I mean, the 100,000 is gonna go somewhere, right? It's gonna go in your pocket. So you're gonna have to pay tax on that.
A common misconception I get actually is people ask me, what if there is a mortgage on the property? And what if I'm selling for 500, but I only net 200,000?
Yeah, it doesn't matter. You still you sell for 500. It doesn't matter like what closing costs you have or what you have to pay off. You have to invest that 500. So if there's a mortgage, right, and you're paying off $100,000 of a mortgage, you have to come out of pocket that 100,000 when you buy.
With either out of pocket or
no, get another loan. Yeah, but
right.
You have to buy for the same or more in order to get 100% deferral.
Right. So the code requires that you sell for the same, and then you purchase for the same value or more, but it's also real estate investment property. So a question I know you and I get often is, does a primary residence apply to Section 1031?
Nope. So you got Section 121 for that. But yeah, you cannot do a 1031 exchange with a primary residence.
For those that don't know, what is Section 121?
So Section 121 is another IRS section in the code that allows a homeowner to sell their primary residence. And if they have a capital gain of $250,000, that first $250,000, you don't pay tax on.
If they own it single.
If they own it single, correct. And then if you're married, you get $500,000. But for every dollar above the $250,000 or the $500,000 mark, you're going to pay capital gains tax.
So let's use an example. And one requirement is that they have to reside, that have to be their primary residence 2 out of the last 5 years that they've owned it.
Yeah. So you got a window of 5 years. So you look back from the date of sale, 5 years. And as long as that was their primary residence at any point in time, 2 years, 2 years out of 5 years, it doesn't have to be concurrent or anything. Just just need 2 years out of those 5, you get the 121.
I mean, I'm telling people, man, that they don't know how much real estate and taxes intertwine. So
Yeah.
let's use your example. Let's say, I mean, I'm single. So let's say I buy a property for $100,000. I live in there for 2 years as my primary residence, and then I decide to sell it, and I'm selling it for $350,000. I'm not paying taxes.
You're not paying tax.
I'm not paying any taxes because I fall under the first threshold, which states that up to $250,000 as a single individual is tax exempt.
Tax exempt. First 250,
So that's
you're good to go.
Free and clear.
Exactly.
Can a primary residence turn into an investment?
It can eventually, yeah. But there's a little trick, right? So it has to be an investment property, ideally for at least 2 years after its primary residence. And
So
then you can...
my same example, where I bought a property for $100,000, but this time I've owned it 4 years. First 2 years I lived in it, then I bought something else, and then I turned that first property into an investment property. I rent it out, whatever it may be. Then I can sell it, and
Yeah, you could 1031 it. You could maybe take advantage of both 121 and...
depends how aggressive
1031.
your accountant.
Yeah, and it also depends how much money you made, right? Like if you netted 250, it's basically the same thing. You're probably gonna want to use your 121, but maybe your gain is higher, and it may it might make more sense to do a 1031 exchange.
Yeah, and a 1031, like I was saying earlier, it's about real estate investment to real estate investment, which comes up the common question that we get is, oh, I heard the 1031, you have to buy like-kind property. What is like-kind property? Is like-kind property, if I'm selling a commercial property, do I have to buy a commercial? If I'm selling a real estate investment condo that I Airbnb, do I have to buy a condo?
Yeah, everybody thinks, yeah, if I buy this, I have to buy this. No, it doesn't matter. That's a huge misconception, like you're saying, right? As long as it's investment property, it doesn't matter. If you want to sell a condo and buy multifamily, you can. If you want to sell multifamily and buy vacant land, you can. If you want to sell, a lease, right? That's one of the other things.
30 years or
lease.
more on a lease.
So if you have a lease with 30 years left or more, you could actually do a 1031 of that.
That qualifies as real property.
Yeah, qualifies as real property.
So, I mean, I can sell my real estate investment condo that I have in Little Havana, and I can go ahead and buy a vacant land in Doral.
Yep.
Okay.
Yeah, it's you hold it for investment. Doesn't matter what type of property.
As long as it's real estate for investment
Real estate.
purposes,
Yep.
it doesn't matter. So that means that I cannot, if I'm going to do a 1031 exchange, sell an investment property and purchase a primary residence.
No, definitely you can't. That's the big no-no in the 1031 business.
That's got tax written all over it.
Yep.
Yeah. No, unfortunately you can't. That's just not qualify. It's specifically meant, and this was done 100 years ago, for investment purposes.
Yeah, to stimulate the economy, promote growth. So that was the intent.
So I have a perfect example of when a primary residence turned into an investment. I had a client who purchased a property for $2 million. They lived in it for about 5 years, and then they sold it another 5 years later, or were selling it. They had turned it into investment the 2 years prior to selling it. So they thought this entire time, they're like, oh, I'm going to pay taxes on this, like, whatever, I'm screwed. And I'm like, no, like, you can do a 1031 exchange as long as you are going to buy investment property, because this turned into an investment the last 3 years. You're like, oh, shit, really? So I saved them about $4 million in taxes total.
Wow.
Because they sold almost 20 million, I think. They sold for. So they sold a single family home that they turned into investment, and then they bought a vacant land. They bought 3 vacant lands that they started constructing on. That's a whole construction improvement exchange. I'm not getting into that. They're very detailed, they're very complex, and that will be on another podcast. But I mean, they're able to 1031 about $3-4 million in taxes because they did it.
Yeah, that's huge. It's funny. I had something similar too. So I had a client that has a house that he bought in 86, I believe 86 or 87, like on Hibiscus or Star Island, like one of those places there in the beach, for like $460,000. Isn't that crazy? Like back then, and now they think they could get $18 million for it.
Oh yeah.
It was their primary residence, but they're gonna, they've been renting it out, I guess, and they're gonna save a ton in taxes by doing a 1031, especially something like that,
Yeah. So I know we've spoken a little bit about the timelines. Some people have heard about the identification deadline. Some people have heard of the 3 property rule. But what are the 3 rules that you may use in a 1031 exchange? for identification purposes.
Yeah, so you got the 3 property rule like you mentioned, and I mentioned a little bit earlier. So you could identify up to 3 properties when you're doing a 1031 exchange. So you sell, the 45-day timeline starts, right? So you could pick any 3 properties you want, regardless of their value, and regardless of where they are too. So that's another misconception, right? So, if I buy in Florida, do I have to stay in Florida? No, you could buy anywhere in the continental United States.
Yeah, it's well, we often say you sell domestic, you can buy domestic.
Yeah, exactly.
So if you sell in Florida, you could buy it in any other state in the United States. Remember, there's a federal tax code.
Yeah.
I would recommend not to buy in California. Personal recommendation there. Only because there's clawback provisions and they'll collect the tax on you, so you won't be able to 1031 again in the future. But go ahead, that's the 3 property rule. Oh, by the way, everyone needs to know that they can, like, throughout the 45 days, make revisions, modifications.
Yeah, they could swap out properties as many times as they want during the 45 days. But
The last one is what you're stuck with.
yeah, exactly.
So that means if I identify 3 properties and day 45 is passed, and I use the 3 property rule, I can't identify anything else. So I either have to buy any of those 3 properties, and if I try to buy a 4th, it won't qualify.
Yeah, you break the rule essentially, right? So
You pay the tax.
yeah, you pay the tax, but you can identify 4 properties, right? With the 200% rule.
Right.
So that's the other rule we have with the 1031 exchanges. So again, your 45-day timeline, you get to pick properties. So you could identify 4 more properties so long as the value of those properties doesn't exceed 200%, or essentially double what the value was of the property that you sold. So if you sold for $1 million, you could identify 4 more properties so long as the total value of those 4 properties or more properties exceed $2 million.
So the 200% rule, you could identify as many properties as you want.
As many as you
So
want.
I can identify 50. I could sell one, identify 50.
Yeah, you could buy 50 properties that are worth $100 each, like you were saying.
I mean,
if you wanted to.
you wish.
But yeah, it doesn't exist. But yeah, as long as you don't go over double what you sold for, you're good to go with the 200% rule.
And then there's one more, the 95% rule.
Yeah, so the 95% rule, like, very uncommon, right? You could identify 4 more properties,
So unlimited amount of
an unlimited amount of properties, so long as you actually acquire 95% of the value of the properties that you identify. So that's kind of tricky, right?
Yeah.
So how do we explain it? So condo is probably the best way to...
Yeah, like a multifamily, yeah.
So yeah, you want to acquire, I guess, 95% of the units, as long as that 95% of the units is also 95%
Yeah, so if it has like
value.
40 units, you can identify 40, and then you have to purchase 95% of the value of all of the units.
Yeah, assuming all the units cost the same, yeah.
Yeah, so that mostly happens when someone's going to buy a lot of condo units or multifamily units, and we see it, but not very often.
Yeah, the main ones are 3 property and 200% rule every once in a while. But yeah, those are the 3 rules. There's no other rules in existence out there. So
Those are your 3 identification rules. If you know about 1031s, you probably know about the 3 property rule, but you'd be surprised. Probably 80% of CPAs don't even know about the other 2 rules, the 200%, 95% rule.
Yeah.
I told you guys I'm going to teach you things that many people don't know, and that's one of them, along with 1031 exchanges. So down here in South Florida, I mean, I just want to say thank you for the Heat and the Panthers now that we're in the playoffs. But down here in South Florida, we do run into foreign nationals a lot. It is very common in South Florida to run into foreign nationals. This is an international hub where people from many countries will come and invest in property. And not only invest in property, they move here sometimes, a lot of times. So can a foreign national do a 1031 exchange?
yeah, absolutely. That's a big misconception too, right? A foreign national can do a 1031 exchange. You don't have to be a U.S. citizen to do a 1031 exchange.
You just have to be a U.S. taxpayer.
You just got to be a U.S. taxpayer, yeah.
You got to pay taxes like a U.S. citizen, but you're not going to have your citizenship.
Yeah. And I think you said it, right? You buy domestic for domestic. If you're a foreigner and for whatever reason you're selling foreign, you can only do a 1031 foreign for foreign. So it's got to be within the U.S.
Well, if you're foreign nationals, that I think you might have confused me a little bit. If you're a foreign national, you could do a 1031 in the United States.
Yeah. The foreign national, if they buy property,
As long as they have an ITIN or an individual tax
Yeah,
identification
exactly.
number is what we call it.
the only thing the foreigners got to look out for though is FIRPTA,
Oh
right?
no, we're not getting into FIRPTA.
Yeah. So that's the
whole
topic of
other-
another class. But I'm sorry.
Basically, if you're a foreign national that owns property in the United States, just know that you're not really the favorite. Actually, you are the favorite of the IRS because they collect more taxes on you.
Yeah,
But you don't
more
get
than you
a
owe.
lot of good benefits. But if you own it as a foreign national, you're going to pay a lot of taxes. So what you were alluding to was the domestic, international rule, which means if I'm a U.S. taxpayer, which I am, I can do a 1031, like you said, sell in Florida and buy in Texas or any other state. What happens if I own a property in a foreign national company or a company, a foreign national country, or, call it Dominican Republic or Colombia?
Yeah, you could do a 1031, but you got to stay foreign. So you can't do a 1031 with your condo in the Dominican Republic and buy something in Miami. So you got to stay outside the U.S.
Right, because what people don't, let's say I own a property in Colombia. What people don't think about is if I sell that property in Colombia, I have to pay taxes in Colombia, and then I have to pay taxes in the United States.
Yeah.
So I get double tax. So what this does is a 1031, but international, worldwide. So it's worldwide. So I'm allowed to sell that property in Colombia and buy another property in Spain and do a 1031 exchange. Yeah, as long as I follow the rules and the timelines and the guidelines, I can still defer the taxes that I would owe here in the United States by buying another international property.
Yeah, and the same rules apply. So you do international for international, you're good to go. Obviously, stick to the same rules, but yeah, you could totally do it.
And I guarantee you 98, 99% of people do not know that.
No, they don't know that. They don't know that at all.
Every time we tell someone that, they're shocked.
Yeah.
I mean, I don't know how many people own international property, but every time we tell someone that, they are absolutely shocked because they had no idea.
I want to get something in Tuscany one of these days.
Yeah, I wish.
A little condo in Paris or something.
Maybe. But it's such a good tool to have, and it's such a shame that people don't know about 1031s and even Section 121. Like, we get a lot of calls where people are like, "Can I 1031 this?" No, but Section 121 applies. It's your primary residence, which is another tax benefit to owning real estate.
Yeah.
It's just real estate and taxes intertwined so much that's why I said it's one of the best assets to invest in.
Yeah, 100%. And one of the things that we get asked all the time is hey, I already sold.
Oh my gosh.
So what's the answer to that question?
We get this question every week. So if you close, it is too late to do a 1031 exchange. Once you close and receive the money, that is a taxable event and you are stuck. You're going to be paying taxes on that money and you can no longer do a 1031 exchange. You know what's funny? I had someone call me last week actually, and they had closed, and we're in May. They had closed in January 2023.
Wow, and they waited.
They're like, "Hey, I was having lunch with my accountant and they're telling me about this 1031 tool." And I'm like, yeah, of course. And then they're like, are you under contract to sell the property? Is it an investment property? How long have you owned it? They're like, oh, yeah, it was an investment property. I had owned it for like 5 years. I'm not under contract. I sold it already. I'm like, what do you mean you sold it already? Like, I closed in January 17, 2023. I'm like,
I used half the money already.
Can I, is there a way to like backtrack, or is there a way that I can do it like so I can still do it 1031? I'm like, no, I mean, you're stuck. You gotta
that's it. As soon as and that's where we come in, right? Is qualified intermediaries. So
not only for good looks.
Yeah. So as soon as the taxpayer, unfortunately, you get what you get, right?
He's 37, so he's not that good looking anymore.
God bless me with his mouth and the head of hair. It's nothing else. So as soon as you touch the money, that's it, right? It's game over. But that's where we come in. So if we hold the money because we're completely independent, that's kind of like the secret sauce,
right?
Or part of the secret sauce for doing a 1031 transaction.
Yeah, it's learning how to play the game. It's kind of like Monopoly.
Yeah.
Really, and people are always talking about creating financial freedom, generational wealth, all this. And I'm like, real estate's one of those biggest assets that lead to that historically.
Yeah, because it's usually always going to appreciate over time, right?
Except not Bitcoin.
Yeah, not Bitcoin, especially now.
And that's how people get to that point, not everyone is blessed where they can, have $1 million in the bank and they could buy 10 properties or whatever it may be. But you have to start from somewhere.
And this is a great tool to start.
If you know this before you even get started, or if you're just getting started at investing in real estate, it's going to take you a lot further than you think that you can get with real estate.
Yeah.
It's going to take you to that next level of real estate. Just because you're able to roll over your equity and your gains and not pay taxes on it and defer it and just keep buying more properties, more properties, more properties, more properties, and more properties.
Yeah, no, you definitely hit it on the head. And we're talking about like Tuscany and all that stuff. So what happens if you have a vacation home? Can we do a 1031 there?
No, it does not qualify. Only in 2 scenarios does a vacation home qualify. So the IRS allows you to use it 14 days or less out of the year to fix it, or 10% or less the amount of days you rented it for to fix it. So what does that mean, the second part? The second part means that if I rented it for 200 days, I can use it to fix it 20 days or less out of that tax year. But, it's possible, right?
Yeah, right. It can be done.
It can fall under one of those 2 rules. And we have seen it happen pretty often.
Yeah, it happens a lot. And what about this? So we could do a whole series on reverse exchange.
Oh, no, we're not getting into that.
but just so that the audience knows that it's possible.
Right, so people, this is like the very, 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 like just barely getting into a 1031. And what we've gone over doesn't even scratch the surface of what you can do with this. So we went over a little bit about what we call a standard forward exchange, where you sell and then you buy every time this, blah, 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 blah. People don't know that you could buy and then sell.
Yeah, because what if you fall in love with something? I want to buy this thing,
right?
But I also want to sell. What if
That's the reverse exchange. People don't know that you can sell and then buy and do construction or improvement. People don't know that you have a contract and you can sell it and do a 1031 exchange. There are so many, the swap and drop, that you get partners that there's just...
Yeah, one person could do it, another... We don't have to.
We're not going to get into all of it. I'm telling you that we're just scratching the surface here, and I'm like dipping your little toes in the water.
The kiddie pool of 1031.
A little kiddie pool. No, a little kiddie pool of real estate and tax benefits, really, honestly. That's what you guys are dipping your toes in, and I promise that if you keep listening to this podcast, I don't know how boring I am, you're going to learn something, and it will probably change your life if you're able to apply it.
Yeah, 100%. Yeah, once we get into like the meat and potatoes of the rest of the 1031 exchanges, yeah, you guys will learn a lot, and there's lots of things that we could do and help you guys save money.
Yeah. So I wanted to thank you guys. Before this guy starts getting into reverse exchanges and more complex stuff, we're gonna talk about that in other episodes. But I want to thank you guys for coming and joining us. Next episode, we'll have a real estate investor who we know personally, and he is the foreclosure guru. So you'll get to learn a lot about foreclosures, how to get into that, how to get into investing in foreclosure, how to find them. And if you don't have money, how to get the money, how to use OPM, what we call other people's money. And of course, don't pay taxes, defer them. Thank you.
Take care, guys.
Affiliated 1031 would like to thank you for watching this episode of the Real Estate and Tax Talk podcast. If you're ready to leverage your gains, you can find us online at affiliated1031.com.